to do, and I want to get right into this right away. This is a great New Year's resolution, finally getting your real estate syndication business off to a great start. And I'm going to give you a bunch of tips today on how to get started and what to do. So let's make no further ado. And for those of you that are coming to our event Crowd Converge on February 1st and 2nd in Las Vegas, this is a great primer for everything that's going to happen there. So this is kind of where we're getting started and then where we're going to go. So the first thing I want to talk about before we start about how to start your real estate syndication is the types of investors that you're looking at. There's three types of investors. There are, in the eyes of the law, there's the unaccredited investor, and those are, it says not so smart, not so rich, and that's a little derogatory because that's actually 97% of the population are unaccredited investors. And those are people who don't meet the accreditation level. And then we have in the middle there sophisticated investors, which is a sliver of those unaccredited investors. Those are people who don't happen to make as much money as the accredited investors or have the same net worth as the accredited investors, but perhaps are going to, are perhaps have some kind of experience in investing, whether it be they've gone to real estate investment meetings or have done alternative meetings or alternative investments, or they have managed some kind of investment, or they're a real estate agent perhaps, and they want to invest in real estate opportunities, or they're a CPA or an attorney or a doctor. They have some kind of higher level of education. And then our number one investor is the accredited investor that makes $200,000 a year as an individual, $300,000 a year as a married couple, or has $1 million in net worth. And actually this is only represents, depending on who you talk to, only represents 3 to 10% of the population. And they're the least protected class of investor in the eyes of the law. And it's important to know that so that we know what type of rule we can fall under. And this particular presentation, although, I'm a lawyer and I deal in the law every day, and that's what our law firm does, this particular presentation is actually going to not so much focus on the law, but more the how-tos. So this first part is just a quick overview of the law, and if you don't get it, don't worry. By the end of the presentation, I'm going to give you an opportunity to get something that's really awesome that will get you to where you need to be in your capital raising. So and we'll give you a nice guide on the rules and what to do in the future. So we have 4 different buckets. I refer to them as buckets that you can fall into on a federal level. And you may notice I'm talking really, really fast right now because we don't have a lot of time and I have a lot of slides. So the first one is crowdfunding. And, this isn't the greatest way to start your real estate syndication, to be honest with you. It is what the law considers quote unquote crowdfunding. It's Regulation CF and allows you to raise only up to $1 million with only $10,000 or 10% of someone's net worth per investor, whichever is less. So it's not a lot of money. And what I'm seeing in these particular deals is people are investing like $200, $300 at a time, not a whole lot of money. So what we really want to do is focus on the rest of the screen here. Rule 506B is the old rule, still a good rule, allows you to raise as much money as you want. You can use a mix of accredited and sophisticated investors, but you can't use any general solicitation. That means you can't advertise for investors. What does that mean? It means you can't go on a Facebook page and say, hey, I'm looking for investors. Who wants to invest? It means you can't say, I'm offering an 8% return on investment. It means you can't do a radio ad. It means all of those things. There are other ways to get investors through your door without necessarily doing that. This presentation today isn't necessarily about marketing, but how to start your real estate syndication. So I want to be clear about that. You're not going to learn everything you need in this particular presentation. Then 506C allows us to do general solicitation. So we can do those advertisements on Facebook or on LinkedIn or what have you. But you can only take accredited investors. And if you'll remember, those are our number one investors. And then finally, we have a mini IPO, which is what a lot of our clients are moving into these days, which is a Regulation A+, allows you to raise up to $50 million, allows you to do general solicitation, and allows you to take money from anybody. So those are great if you're really looking to grow your business, if you're looking to raise bigger bucks, and if you're looking to perhaps give the little guy a chance at investing in some of your real estate deals. So that's a good cursory overview of the law. So let's get into the how-tos of starting real estate syndication. And one of the questions I always get asked is, well, what do I do? Do I form a corporation? Do I form an LLC? Do I form a partnership? Do I do a joint venture? And this right here is a very typical structure. And what we usually see is that the manager LLC, this is where you and your management team will quote unquote reside. You're going to sit here in this management LLC and manage these property LLCs, which will then own individual properties. And you really, especially if you're syndicating bigger deals, not necessarily single family flips, but if you're doing multifamily, self-storage properties, anything to that effect, your bank, if you have financing on that deal, is only going to allow you to hold that one property in that one LLC. So manager LLC manages property LLC, and property LLC holds one property. So where do your investors go? Your investors will go into each individual LLC. So if you're syndicating an individual deal, they're going to invest in this property LLC right here, and they're going to be a member of property number one LLC, or they're going to be a member of property number two LLC. So a question I always get is, why, Jillian, do we have to have a manager LLC? It's just me. Don't I want to save some money on taxes or tax returns or what have you? And maybe that is the case, but quite frankly, that isn't the best strategy from a liability perspective or from a legacy perspective. And what do I mean by that? So if you're just little old you as the manager, managing property LLC 1 or property LLC 2, then you have exposed yourself to certain liabilities as an individual manager, whereas there's an extra corporate veil that would have to be pierced before they could get to you if you have this manager LLC in place. The other reason why you want to have manager LLC is let's just say you and your friend Joe decide to start manager LLC and venture out and raise capital, but then you and Joe get in a fight and you have to replace Joe. Well, if you replace Joe and you're both managers of property number one LLC as individuals, it might, depending on what that operating agreement says, be a little more difficult to replace Joe. So then what do we do? Then what we do is we have this manager LLC where you and Joe can work it out or duke it out or whatever you're going to do in manager LLC with not disturbing your investors underneath you at all. So that's why we want to do that. So let's move on. So the next question I always get is, where do I form my company? And, this really is going to depend on a couple things. Where's your property, number one? Where are you, and where are your investors? Oftentimes I hear people ask me questions like, don't I want to form in Delaware or Nevada or Wyoming or one of these states that has great tax laws or great liability laws or, great protection, like Wyoming, for example, is a very secretive state. So where do you want to form? Well, I'm going to tell you right now, I'm in California, so I'm going to address California first. If your property is in California, your investors are in California, and you're in California, you best form in California, because the reality is that California will come and get you. And a lot of states are moving towards this, that if you're in their state and have a presence in that state, then you need to form in that state. So that's why we have California. When somebody asks me if they live in California, I say form in that state. And then the other question I always get, well, what if I form in Delaware and my property is, say, in Texas? Well, the bank most likely is going to make you form an LLC in Texas to acquire that property. So really the answer to the question is where is your property located? Because if you have any kind of bank financing whatsoever, that bank is going to make you form an LLC in that state to acquire that property. Now, when would it be appropriate to use Delaware or Nevada or Wyoming? When you're starting a fund, and then that fund is going to own other LLCs, what we call special purpose entities, to own specific properties in different states. So another question I always get asked is, well, okay, so that's good, but now how am I going to get paid? What kind of fees can I charge? And there's a ton of different fees you can charge. Now, the first thing, obviously you're doing this because there's profitability within syndicating real estate. And usually the profitability is in the real estate itself, not just in charging the fees. So the first thing you're going to get, which is not actually on this chart here or this slide, is you're going to get some kind of piece of the deal. And the piece of the deal is going to depend on a couple of things. And we're going to get to that. We're going to actually work backwards. I'm going to teach you how to work backwards on figuring out what you should get out of the deal. But what are some of the other fees you can charge besides equity in the deal? Well, we have an acquisition fee. An acquisition fee is usually based on 1% to 3% on the purchase of the property. So if you are acquiring property and you do all the work to acquire that property, then you are entitled, or you can make yourself entitled, to get an acquisition fee of 1% to 3% on the property. There's a disposition fee, which is usually 1% to 3% on the disposition of the property. There's a construction management fee if there is actual construction management. And construction management is usually 10% of the cost of construction, and you may or may not want to charge that. It depends on if you have a general contractor or if you're doing the work yourself. An asset management fee is usually based on the revenues on a monthly basis from a particular property, and that can be anywhere from 1% to 2% of the gross revenues of the property. Due diligence fee, which is basically for doing the due diligence on a property, and on the larger properties, there's a lot of due diligence. And then also a loan refinance fee. Now, I get a lot of resistance from some of my clients who say, oh, I don't want to charge any fees at all. I want this to be a fee-free fund or fee-free syndication. I want my investors to know that I'm not charging any fees, but usually I'm going to insist upon you getting a loan refinance fee. Prior to practicing as a lawyer, I was in real estate development myself, and one of the big things that I did was I did all of the work for loan refinancing. And I'll tell you, it was a full-time job. It was an 8 to 10 hour day job just to get a loan refinanced on a property, or even to just get a loan on the property. So I kind of insist on you taking the loan refinance fee because it's to the advantage of the investors that you're doing this refinance. Otherwise, you probably wouldn't be doing it. And therefore, that extra effort that you're putting in, I think needs to be rewarded. So I usually suggest you charge anywhere from 1% to 2% on the amount of the loan as a loan refinance fee. But that's totally up. Everything's totally up to you. This is your deal. I'm just telling you what you're capable of doing. Now, this is for a real estate syndication. And I'm not really touching on the fact that if you're going out and buying notes or doing lending or something to that effect, which has a whole other group of fees. So at the end of the day, what you want to do is make a list of all the tasks that you're doing to acquire a property, to acquire a note, to manage a property, manage a note, do a loan, whatever it might be. Write down all those tasks and then write down the ones you want to get paid for. Which ones you're willing to take equity for, and then the other ones that you need to get some kind of extra fee for because you know the extra effort that goes into it. So as it says in that last bullet point, it depends on you, it depends on the assets, it depends on, is this your first deal or your 17th deal? Is there ground up construction involved? The more complicated the deal, the more fees you're probably going to end up charging. Okay, so another question I always get is, can I find investors on Facebook or LinkedIn or Bigger Pockets? So The big deal is, remember early on, I talked about 506B and 506C and Regulation A. There is only under 506C and Regulation A can you actually really advertise. So if we're starting off with our first real estate syndication, our first deal, it's the first time we're going to syndicate, or maybe it's your second time and you're just syndicating that one deal. Regulation A is kind of to the side. We're not quite ready to do that yet. We're not going to quite do that yet. So we're really just looking at Rule 506C as in Charlie. And what does that rule say again? It says we can raise money as much as we want. We can use general solicitation, but we can only take it from accredited investors. And again, here are who our accredited investors are. So here, just a real quick snapshot. Where can you advertise for investors? Where can you use that general solicitation? Rule 506C, Regulation A, or Reg CF, which I don't recommend to anybody who's actually syndicating a deal for the first time or for the second time or the third time. I recommend you stay in Rule 506C or Regulation A. And for most of you out there who want to advertise for investors for your real estate syndication, I'm going to recommend Rule 506C. So let's just say you have a group of people that you're friends with, family, whatever it might be, and they're not accredited investors. And you think, but gosh darn it, I want to take their money. They're good people. They're good investors. How can I take their money if they're not accredited? So let's talk about alternative ways to get people into your real estate syndication without generally soliciting and while still maintaining the integrity of your deal. And so what does this mean? It means we're doing a Rule 506B as in boy offering. So we have our deal, we know what the deal looks like, we know what our fees we're going to charge, we know what we're going to offer our investors, we know we're going to create our LLC. We know the structure of the syndication itself. We know we're going to do an LLC as our management. We're going to have a LLC for our property. So then what is our message? So the first thing we're going to do is figure out what the message is. What is your message? Is your message that you're in an emerging market that has incredible growth potential? Or is your message that you're buying a Class A property that has incredible cash flow and you're buying it at a discount? Or is your message that you believe there's a downturn coming, so self-storage is where it's at, and we're going to see an uptick in self-storage usage? I will tell you right now, where I'm living, I'm seeing 2 ground-up construction self-storage facilities going up right now. So self-storage is a huge thing right now, as are mobile home parks, and as always, multifamily is always on fire. So you just got to figure out what your message is about your particular deal. And that is the first thing you want to think about. What intrigued you about investing in the property? There must have been something. And a lot of you are going to say, well, yeah, because it has great returns. That is a message, though, that everybody says. Everybody has great returns. So you need to find out what your unique position is and what your particular message is, and then disseminate that message. And the message doesn't have to just be limited to the property. The message should also probably, most likely, be about you, because at the end of the day, the investors are trusting you, the manager, with their money. And they're trusting that your expertise is what got them into this situation in the first place. So figure out what your message is and start disseminating that. And that doesn't mean you're asking for money. It just means that you're talking about what you know and who you are and what your level of expertise is. Okay, so number 2, design the message. Design the message. So what do I mean by this? I mean, the message that you send out to your investors should always have a similar tone every single time, so that the investor gets used to hearing the message. If we think about the most famous jingles that we know, we immediately relate those jingles to a particular brand, and we think about the brand and the branding. So you want to design that and design what you're all about. So I'll use a health guru that I know, for example, every single message that he puts out on his page. And I remember I used to watch him early on when he started out in his health guru career and then moved on and built up his business, and his message changed. And he changed from one consistent message to another consistent message because the design of the second message worked better for him. So the first one was covered in humor, and I thought it was great. I love to laugh, and I think everything that's inappropriate usually is funny, which I don't know what that says about me, but that's another story for another day. So he had this message of humor with health, and would always put this message of humor and health out. And then he designed the message in a little bit of a different way, and he started going for a motivational, you're beautiful, you're lovely, tell me about you type of message to the world. And it actually increased his audience quite a bit. And that is the message that he consistently puts out. So, which leads us to our next thing, is he delivered the message. Where did he deliver that message? On Facebook all the time. Now, I'm not saying that you have to go on Facebook all the time, but you have to find a way to deliver your message. And it doesn't even have to be social media. It could be at your local RIA group. It could be at your local Rotary Club in your community. It could be on LinkedIn. It could be on Bigger Pockets. I see some great people delivering messages constantly on Bigger Pockets. And what is the message that they're delivering? They're delivering expertise in the areas that they're experts on. They're offering advice to new investors. They're helping people. I can't tell you how many times I've just offered somebody a little piece of advice, and I got 5 phone calls later from people who said, hey, I saw you delivered a particular message on Bigger Pockets, and I'd like to talk to you more about it. And usually, if you look at the designs of my messages, they're usually pretty short and sweet. I try not to get too lengthy in my posts on Bigger Pockets or Facebook or LinkedIn, because I feel like no one's going to read it if it's that long. If somebody wants more information, they'll contact me. I don't want to bore everyone to death. So how did I design my message? Short, sweet, to the point, with facts and circumstances woven into it, without it being overly wordy and boring. I do not want to be boring. I hope I'm not boring you now. If I am, I apologize. You can tell me in the comments later, but much later. I don't want to cry on screen. Anyhow, what's the next thing you need to do? You need to be consistent with the message. So back to my health guru guy, what was he doing? He was posting every single day a positive body image message to tell people how beautiful they were. And it's consistent and constant. I can't tell you how many times I have a real estate syndicator come to me and say, okay, I've got my documents, I'm going out, I'm raising money. And then they go on Facebook for 2 weeks and say, who wants to invest in my deal? Or they put out some kind of message, and then they do it only for those 2 weeks and nothing else. And that's it. So that is not a great way to raise credibility or equity, with the trust equity with your investors. They have to see a consistent and constant message. You cannot give up on the consistent and constant message. And here's another thing. Even if you do not have a deal right now, or you're syndicating nothing right now, you should be out and giving these consistent and constant marketing messages to your crowd, whether that crowd's on Facebook, your local RIA group, your friends and family, whoever your crowd might be. You have to be giving a consistent and constant message so that they know in their mind where to go to invest when the time comes that you actually have a syndication deal. So what are the steps that you need to take after this webinar today? Well, first one, I want you to work backwards. What do I mean by that? So the thing I get all the time with people who say, I want to start a real estate syndication and I want to offer my investors 10% return on investment. And I go, great, why? They go, well, because that's what investors want. You should never start from a position of what investors want, but rather start from a position of what do you want? What do you want? So that's the first number I want you to write down is, what do you want? What is worth your time? What amount of money is worth your time? So if you start with that number, then you go out and look for properties that are going to support that number. And then you work backwards. So if your number is 10% and you find a deal that makes 20% return on investment, you have 20%. That's what you believe the property is going to make. You want to make 10% on invested capital, whether it's yours or your investors. That leaves 10% left over. What does that mean that you can pay your investors? Well, a lot of people would say, well, that means I can pay my investors 10%. That is not correct. That means you can pay your investors 8%. Why? Because you forgot the contingency. Do not overpromise and underdeliver. You always want to promise less than what you can actually and could afford. So, underpromise, overdeliver on returns always. So many times I see people out there going, I'm going to give you 18, 20, 25% return on investment. That's not appealing at all. As a matter of fact, it builds up a lot of distrust because people believe it's too good to be true. You want to be realistic with your goals, and you also want to pay yourself. It is not a bragging right to your investors to say, hey, I'm not getting paid. I'm not getting paid at all. I'm not getting anything. Where's the motivation for you if you're not getting paid? Now, you could still pay your investors first by offering them what we call a preferred return, where they get a return on their money before you get paid. But you always need to get paid. Otherwise, why are you doing this? And you need to get paid enough. You need to get paid more than what you would be making at a day job. You need to get paid enough to make you motivated. So always work backwards. So what's step number 2? Oops, I went backwards. Sorry. Number 2, find a property or plan a fund. So find a property. So you've figured out now how much you need to get paid, and now you know I need to get paid X, and that therefore I need to look for properties that make this kind of return. So now you're going to find a property that fits X. And also Y and Z. And what are Y and Z? What you're going to pay your investors and what your contingency is going to be. So you need X plus Y plus Z equals property. And you're going to go out and find your property that fits that, or you're going to plan a fund that would support that. Number 3, start your marketing. You can start your marketing way before you have a property, way before you have the fund. Start your marketing now to build up your tribe. And the things you can do out there is doing that consistent marketing message and telling people out there what it is you're up to and what you're into. And whether it's self-storage or multifamily or doing a land deal or ground up construction, whatever it is, I get calls all the time about different people in different, in the varied states of real estate, the varied asset classes of real estate, and they all have something to offer, and so do you. Just by watching this webinar today, you're in the right step of building your real estate education. You can go out and repeat this entire webinar. I completely give you permission and tell everybody what you learned. The more you talk about what you know, the more people are going to understand that you have something that they don't, which is the knowledge to make an investment work. Then once you find that property and plan out your fund, and now you've started a little bit of marketing, you're going to call your attorney, and hopefully that will be me. So you're going to call your attorney and have them start getting the paperwork together. Because what are the things that you need to actually do a fund or a syndication? Well, you need what's called a private placement memorandum, This is basically the doomsday of what's going to happen in the event that you lose the investor's money or the property burns down. It's all the risk factors. It tells the investor the who, what, where, when, how much, and why of the deal. It tells them exactly how much money they need to invest, when they can expect their money back, all of those good things. Finally, you want to finalize your documents. That's what your attorney's doing for you, that private placement memorandum. The other thing you're going to need is what's called an operating agreement that tells them how the company is going to run, that LLC, how it's going to run. A subscription agreement. This is now the agreement between you and the investor, where the investor says, hey, I'm ready to invest. I understand what I'm investing in. I understand what the terms and conditions of the investment are. I've read all the documents. Here's all my information, and I'm fully prepared to invest. And then what also happens is your attorney will file what's called a Form D, with the states and the Securities Exchange Commission to say that you're using a certain exemption, whether that's 506B as in boy or 506C as in Charlie. And then finally, you're going to go out there and start raising that money. So I have a couple of free things for you. I want to tell you real quick. I have a couple of steps for you to take. First, I want you to write down what your goal is for this year in terms of raising money. And that goal can be, I want to acquire X amount of properties, or I want to acquire this type of property, or I want to start a fund where I'll raise this amount of money, or I want to make X amount of dollars this year. Whatever that goal is in terms of money raising, I want you before the end of the day to write that goal down. That's a great way to start off, get going, and really jumpstart. Because if you don't have that written down, there's no point of calling me. There's no point of calling me. There's no point of going out and looking at properties if you don't know what you're looking for. So you want to first figure out what that goal is. And then once you get that goal, then you can start that working backwards approach. So I have a couple tools. I'm going to tell you exactly how you can get them for free. And stay with me to the end here, because I'm going to take all of your questions. If you will look up, there's a Q&A, and if you just click on the Q&A and type in your question, I will get to your question before we end here today. So I'm going to tell you about how you can get my home study course for free. I have this home study course. It's delivered digitally online. There are 6 courses within the program. It's super easy to understand. I'm actually in the process of updating it. It's evergreen. You'll never have to buy it once you get it for free. And you'll get all of the updates that come with it. I do sell this online for $14.97, but I'm going to tell you all how you can get it for free today. So it comes with, starts off with 3 instructional videos, 6 steps of putting your plan together, setting up your website for success, structuring a deal investors cannot refuse. And that takes basically this presentation here, and then each video is about 45 minutes long, and so goes into even greater detail on all of the little things that we touched on today. For example, under structuring a deal investors cannot refuse. One of the things is I always get from people is, how can I get more money out of my investors? Like, I often get my investors saying, I only have $5,000 to invest. How can I get over that objection? And I'm going to teach you how to get over that objection. And I'm also going to teach you how to get people to invest faster. Like, where somebody says, how many times do we have somebody say, oh, I'm going to invest, I'm going to invest, I'm going to invest. And you're running up against the deadline to close on your property and they still haven't invested, but they swear they're going to invest. How can we get them to move faster and get that money into your subscription account? All right, so here are the courses that are involved. Setting up your real estate investment company. I teach you how to do that, how to write your real estate investment plan, all the private money basics, staying within the law, what to offer your investors, how to find investors, and then finally putting your offering together. It's 6 courses. It's easy to understand, and you go right through it within the online course. And I do try to update it from time to time with more bigger, badder information, new things that I've learned. I'm constantly learning about great techniques on how to raise private money, and I try to update the course with that so that you'll have that. And then we give you a bunch of templates, operating agreements, partnership agreements. I give you an example of real estate investment trust. I also give you a comprehensive spreadsheet program where you can work your numbers out, and a bunch of other great things from the SEC. And if you can't sleep at night, I have a 360-page Word document on there that is all 50 states, securities laws. And some night when you can't sleep and you start reading that and you fall asleep, you can call me the next morning and thank me. Okay, so how can you get this for free? Well, I want to tell you, we have an event coming up. It's called Crowd Converge. It's in fabulous Las Vegas. It's February 1st and 2nd. And here are just a couple of the quotes from last year. Who comes to this event? We have investors, we have developers, we have people who've done crowdfunding campaigns, and we're going to teach you how to raise all your money. And it's not just about crowdfunding online. I had somebody call me this morning and say, I want to do this, I want to do that. And I said, you should come to Crowd Converge, to which he responded, I don't want to do crowdfunding. Well, Crowd Converge, oddly enough, is not just about crowdfunding from people online. Crowd Converge is about how really to not just get investors into your door, whether it be online, through education-based marketing, through using a portal, whatever it might be, through using a broker-dealer, a DST. These are all the things we're going to discuss. But it's also how to treat your investors later and how to structure your deal. So we had some amazing people come out last year, and some people who were doing huge deals. As that quote in the left-hand side says, I thought I was a big shot, but I came here and I met a whole bunch of other people that are raising $25, $50 million for their different deals. And that was what the crowd was full of. And I want you to be there so you can mix and mingle with these people. So how do you get the home study course for free? If you sign up for Crowd Converge today, you book your hotel room, I will give you the course completely for free, and you will get it as soon as you sign up. You will not wait. I will get it to you right away. As a matter of fact, you can email me as soon as you sign up, and I'll give you my email address here at the end. You can email me, and I will immediately add you to the online course, and you can get started on it right away. So just go to Crowd 2018, book your hotel room, book your tickets, let me know, you'll get the course for free. And I'm really looking forward to seeing you all there. Crowd Converge is actually less than the cost of the home study course. I sell the home study course for $14.97. Crowd Converge is only $9.95. So you're getting quite the bargain. All right, Jillian, I know there's a bunch of you on here who are going to Crowd Converge. I know there's a bunch of you. So the question you're going to ask me, do I get the course for free? And the answer is, of course you do. So email me that you're already coming, and I will, of course, give you the course for free because I really appreciate the fact that you purchased it. And did I say crowd2018.net? I meant to say crowd2018.com. Crowd2018.com. That's where you sign up. Okay, so I said to all of you, regardless of what happened today, I was going to give you something for free. So I've been going through this law really fast, and I get it, and perhaps not all of it sunk in. So I have this really helpful chart I'm happy to send off to you. All you have to do is send me an email, helpful chart in the subject line, to Jillian@crowdfundinglawyers.net. That's Jillian@crowdfundinglawyers.net, and I will send that chart right off to you. Okay, now I want to encourage you. I see a couple of you guys asking questions. I want to encourage you to keep asking those questions, and I'll answer them here in a second. And if you need to get in touch with me, here you go. Now, don't forget to sign up today for Crowd Converge, because this offer is good for today only, or if you've already signed up for Crowd Converge, I will send you it. So here we go. Will this be recorded for the rest of my team? Yes, it will. It will be recorded, and I will send out an email blast to our mailing list to say where it's recorded and housed and things like that so that you can download it later. Okay, Michael asks, if I want to start a crowdfunding site targeting investors in Korea, regulation crowdfunding is the only option. Can I have two sorry everyone. Can I have two platforms? One used regulation crowdfunding and the other site used regulation 506C. How do I qualify Korean investors as accredited investors? Well, Michael, actually, you don't need to qualify your Korean investors. Your Korean investors actually can invest in anything under Regulation S. Foreign investors do not apply to the accredited investor rule. So there's this rule called Regulation S. I didn't touch on it today, but a foreign investor can indeed invest in a Regulation 506, Regulation D, Rule 506C, that's the proper name. It's Regulation D, Rule 506C offering as a foreigner, not being necessarily accredited. The other thing I normally recommend, however, is that if you are taking in foreign investors, we use what's called a block. I'm getting into some advanced stuff here, so bear with me. Is we use what's called a blocker company or blocker entity, and all of our foreign investors go in that blocker entity so they're not adversely affected by taxes. So yeah, if you have a question about Regulation S, foreign investors, how we set that up, please feel free to contact me, Jillian at crowdfundinglawyers.net. Arun asks, what is a disposition fee? Oh, good question. I guess I kind of just glazed right over that. I apologize. I've been speaking awfully fast. So a disposition fee is simply a fee that you get paid once you dispose of the property. Because as we know, purchasing a property is difficult, and then selling a property is sometimes difficult. So we want to get paid on both ends of the transaction. So the disposition fee is usually 1 to 3% of the sales price of the property. So you are encouraged, if you will, to sell that property for the most money that you can, which is good for you and good for your investors. What amount is typical for asset management fees? That's a great question, Thomas. Usually what I see as a typical amount for asset management fees depends on one thing. Are you managing the property yourself, or do you have a third-party manager? So if you're managing the property yourself, generally speaking, you're going to go for market rates. And usually the market rate is anywhere, I've seen them as low as 4% of the gross revenue of the property. And in somewhere like Anchorage, Alaska, where property management is at a premium, I see up to 7%, believe it or not. And in some cases, if you're doing Airbnb rentals, and that is a thing, Airbnb rental funds and things like that, Airbnb rental type management is 25%, which is, pretty nice if you get into that. But if you're not managing the property yourself and you're just managing a manager, a third-party manager, generally speaking, we see 1 to 3%. I see a bunch of you raising your hands. I'm going to ask you to use the Q&A box, please, to ask your questions so I can read them out loud. So what kind of license do I need? A Series 22. Well, Tom, no, you don't need a Series 22 so long as you're not accepting a commission for the sale of the securities. We have what is called an issuer exemption. And an issuer exemption allows you to sell your own securities without any kind of registration or license requirements. A Series 22, for those of you that don't know, is a private placement memorandum sales license, specifically for PPMs, a securities license, but you do not need that license, and I do not even encourage you to get that license if you are just selling your own securities and you're not taking a commission. Jeff's asking, do we get this as part of enrollment for Vegas? Do you get the Home Study course? The Home Study course is yours free if you sign up for Crowd Converge today and get your hotel room. And Pilar says, hi, Jillian, and I say hi back. So thank you. Oh, and then she asks a question. That's good. Will you be presenting content regarding family office funding? I can. I won't be doing it today, obviously, but we could do something about how to approach family offices. Sure, that's a great topic for a future webinar. I'm hoping to do these more regularly, so I'll let you know. All right, Diane asks, Jillian, I'm not able to attend the event in Vegas. How do I get a link to buy the course? Diane, I will get that to you. Thank you so much. And Richard asks, should you act as the real estate broker rep for your partnerships? Richard, that's a great question. I have a lot of clients who have their real estate brokerage license, and we write right in the documents, I am a real estate broker and I may receive a brokerage fee for brokering this transaction. It's not like any other broker is going to do a better job than you for your own property. So if you're charging a fair fee for your brokerage services, then let's do it. So hold on, I just want to click off a couple of things here, and I'm going to ask Lauren if anybody's asking any questions on the Facebook Live. We're actually Facebook Live now too, and there might be some people asking questions there. So, and if you are, continue to ask your questions because I will answer them. And let's continue on with our questions here. So hopefully, Richard, that helps out with your question. Keith's asking, how do you feel about putting deals on Palico? Well, let me tell you, Keith, I don't know how I feel because I don't know what Palico is. I'm sorry. If you could tell me what Palico is, I will come up with an answer for you. I apologize. Alpish, I hope I pronounced your name right, asks, I am glad that you reminded me of CrowdConverge. I forgot to register and I had a promo code for it. I can't seem to find that promo code. Can you please send it again? I may have deleted that email. Do me a favor, Alpesh, if you'll email me. I don't have any promo codes right now. I don't know if any exist or if any of our affiliates out there have promo cards, but do me a favor and email. I'm going to give you a number, a better one. I'm going to give you an email address. Please email Lauren@crowdfundinglawyers.net. That's Lauren@crowdfundinglawyers.net. And it's LAUREN. And she'll put you on a list if we ever come up with any. But honestly, Alpish, I would just register today at the regular price and get the free home study course. I mean, it's worth $14.97, so it's better than any promo code you could possibly get. Okay, Anonymous asks, is that like Anonymous, like the hacking group? Are you like are you gonna hack me next? All right, Anonymous isn't answering. Anyhow, Anonymous asks, what is a typical percentage for a due diligence fee? It depends. So usually, again, we're looking at 1 to 3%. I keep saying this 1 to 3% range. It depends on your experience. It depends on how hard the due diligence is for the property. A lot of times the due diligence fee is based on the capital, the equity capital, and not the actual price of the property. And then Gary, Gary, are you anonymous? Gary Culler's not an anonymous person. Gary asked, what is a typical due diligence fee as well? So hopefully that answers your question. Can a licensed registered investment advisor, Series 7, Series 66, complete real estate syndications? Absolutely. But I'm going to give you a big warning if you have a Series 7 or a Series 66. And I'm going to use some colorful language. For any of you out there that have a Series 7 or Series 66 or have ever dealt with FINRA, you know FINRA is a bitch. So if you can give up that Series 7 or Series 66, I encourage you to do so. If you cannot and you want to continue on, there are certain things that you need to do in order to make sure you are really providing for your investors a disclosure that's appropriate. And then you also have to report to FINRA that what you're doing, that you are selling your own securities. So you do have to disclose all of this to FINRA. You have to disclose all of this to your investors, but you absolutely can do it. I've had plenty of clients before who've had their Series 7 and Series 66. Do you know of or like any particular software for investor administration and accounting? Okay, so that's a great question. And quite frankly, I think you can set up QuickBooks to work phenomenally with investor just doing your accounting. But we have a service provider who's actually coming to Crowd Converge that you'll want to talk to. They're called IMS. They have a great platform, so I would definitely check them out. They're investment management services, actually. So check them out. And if you're coming to Crowd Converge, Richard, definitely come by and talk to IMS. They'll be there, and they're doing a panel on how to report out to your investors as well. So Rick, my goodness, the questions keep coming. You guys are wearing me down. We're going to keep going, though. I don't have anything else to do. I like this. This is fun. Okay, so Rick asks, what net worth on the balance sheet of the managing LLP is generally required to advert personal guarantee? Okay. I'm assuming you meant to say avoid personal guarantee. Rick, you should always avoid personal guarantee. I know there's a lot of people out there that teach people who are teaching passive investors or private money lenders that they should always get a personal guarantee. I'm telling you right now, do not offer a personal guarantee. First of all, you don't need to do it. The property should stand on its own, number one. Number two, I always see a personal guarantee as a measure of desperation. Like you're so desperate to sell this opportunity that you're willing to offer a personal guarantee. Remember, you have the opportunity, and cash is a commodity. So opportunities are not necessarily commodities, but cash is. And you can get more of it, and you can create more of it. But you know, opportunities are more hard to come by than cash is. All money is green, but not all investors are created equal. So keep that in mind when you're looking out for investors and giving, you know, your last, you know, drip of blood, if you will, to these investors for their cash. Don't do it. Just remember, if one investor says no, there's another investor out there that will say yes. And if you're finding a lot of investors saying no, then re-examine your message, the property, whatever it might be that you're doing. But don't give up, and don't feel like you have to give personal guarantees, because you definitely do not. And Rick, I want to keep going at this, because I'll tell you right now, half of my clients who create new management companies for the purposes of managing these syndications oftentimes are brand new and have nothing on the balance sheet. So you do not need to do any kind of personal guarantee. Now, I'm talking about for investors. The bank is a different situation. The bank, when you're going to leverage your property, is going to require anybody who has 20% or more interest in the property to probably go on the loan. And it still might be a non-recourse loan, but you're probably going to have to put your credit up for that purpose. So hopefully that answers your question. So Chad asks for a copy to the course. Sure. And Richard asks, can the syndicator provide class shares in the partnership for anyone that helps raise equity if they are not SEC licensed? Richard, that is a great question. And the short answer is yes. However, it's got to be very narrowly tailored. It's got to be the duties of the people who are helping raising funds have to extend beyond raising funds. They have to be involved in the company itself, and their interest, generally speaking, has to be subordinated to those investors who are money investors. So, for example, you might give a Class A share to your investors and then divvy up the Class B shares to the management and to the money raisers, if you will. Okay, so Palico is the leading, Keith told me, Palico is the leading online marketplace for the private equity fund community, connecting qualified investors with fund managers and secondary market participants worldwide. I'm gonna go check that out. Thank you, Keith, for that hint. So anybody who wants to go check out Keith's hint, Palico, it's Palico. Janetta asks if anybody can get CLE credit. I don't know. Maybe I'll try to get it qualified for that, though. Sam asks, what obligation do I have to investors if a syndication fails, especially if I promised a preferred return? That's the beauty of a preferred return. The preferred return is only if you are successful. Now, so look, we want you to be successful. We want your investors to get their money back. We don't want you to make promises that you cannot keep. However, the reality is if the syndication fails, you do not have any personal obligation to your investors to pay them that preferred return if the project did not yield the returns that you were hoping for. What is the typical amount of equity the manager should take? Tim, that is totally dependent on the project itself and what you need to make and what your investors are investing. So I see it anywhere from I'll give you a perfect example of an extreme. I have one deal right now where the investors get paid 7% preferred return, and that's it. And the manager takes all the equity, takes all the upside. And then I see other situations where the management gets as little as 25% return on investment. So it really can vary. Jen asks, are we okay if we have a Series 6 or 63? Yes. And how can novices just getting started benefit from the Vegas event? Because Nick, we're going to teach you how to start from the beginning. We're going to do a cursory overview of the law, and then you're going to meet all the people who can help you raise money, who can teach you how to raise money, and who can help you with your deals later on. Anybody's going to benefit from this event, trust me. And I know that sounds like a big promise. I can deliver. I can most certainly deliver on that promise. I am still looking for questions. What is the difference between regular registration and regular registration with breakout session? I'm trying to change my schedule around so I can attend. Oh, Diane, I'm so glad you asked this question. Okay. Our special speaker, our keynote speaker for the event is a gentleman by the name of Oren Klaff. And he wrote this book called Pitch Anything. This book changed the way I viewed money raising. I read it a couple of years ago. And after last year's event, literally the moment last year's event ended, I said to Jean, my partner, I have to get this guy to speak at Crowd Converge. And he is a master at equity fundraising. He has pitched pretty much anything, and he's going to teach you how to pitch your deals. I did a video with him. I just taped it yesterday. We're getting it subtitled so people who are watching it on Facebook at work and aren't supposed to be watching it Facebook on work can watch it and read the subtitles. I'm hoping to have that out on Tuesday. He is phenomenal, and he's doing a special breakout session to teach you specifically how to raise money for your specific deal. That's going to happen on the first night, so right after the cocktail party. Sam asks, would you have a system of evaluating a syndication offered by others prior to investing as an investor? Okay, Sam, I'm going to hold off and answer your question because I'm planning on doing another webinar just about that subject on what to look for when investing passively. So please be on the lookout for that webinar, how to invest passively in private placement memorandums. And I'm going to tell you exactly how to dissect a PPM and what to look for when investing. And Jen asks, what is the name of the book again? If you're looking for the name of Oren's book, it's called Pitch Anything. So, and you can get that on Amazon. And I think, did we have any questions on Facebook Live? We didn't have any questions on Facebook Live. You guys were awesome. Your questions were awesome. You were a wonderful audience. I hope you had a great time. We went way over. So I know some of you got a lot of things to do. So do I. Let's go. I'll talk to you guys soon, and I'll see some of you at Crowd Converge. Thanks so much for coming.